In this video we are going to talk about best high monthly dividend stocks with growth. So before starting, please like this video and subscribe to this channel for future updates. The labor market in the United States has been substantially disrupted by the coronavirus epidemic, according to a Congressional Research Service report released and revised in June, with the unemployment rate reaching 14.8% in April 2020. This was the highest level of unemployment since 1948, and the unemployment rate in the United States stayed higher, at 5.8%, until May 2021, than it had been in February 2020. 3.5%. These figures are just used to emphasize an already well-known fact: individuals have been out of work since the pandemic reached the United States, with most households left without a reliable source of income. Monthly dividend stocks can be useful in this situation. Monthly dividend stocks, or rather any dividend stocks, can be fantastic investment options for those looking for a consistent and passive income stream that can help them out through times of financial instability and volatility, such as the current epidemic. In fact, according to a Reuters article from July, more and more investors are gravitating towards dividend stocks due to inflation fears and a conviction that Treasury yields will be less appealing in the second half of 2021. According to reports, the market will begin to focus on companies that will boost their payout ratios and current returns in the near future, according to Bob Leininger, a portfolio manager at Gabelli Funds. According to Goldman Sachs analysts, around 22 of the 57 businesses that cut or stopped dividends last year have restarted or raised their yields, with another 19 anticipated to follow suit by the end of 2021. This year, financial companies are forecast to spend more than $130 billion on stock buybacks and dividend payouts, indicating that companies are increasing dividend payouts to fulfill investor demand. Even for the smart money, investing is becoming more difficult by the day. The new financial landscape is reverberating throughout the hedge fund business. Its image has been tarnished in the recent decade, when its hedged returns failed to keep up with the market indices' unhedged returns. Insider Monkey's data, on the other hand, was able to predict ahead of time a small set of hedge fund holdings that had outperformed the S&P 500 ETFs by more than 124 percentage points since March 2017. Our monthly newsletter's stock choices returned 197.2% between March 2017 and February 26, 2021, compared to 72.4% for the SPY. By more than 124 percentage points, our stock recommendations outpaced the market. See the details here. We were also able to identify a small set of hedge fund positions that underperformed the market ahead of time. Since February 2017, we've been tracking and distributing the list of these stocks, and they've lost 13% as of November 16. As a result, we believe hedge fund sentiment is a valuable indication that investors should monitor. To receive our stories in your inbox, sign up for our free newsletter on our homepage. Let's have a look at the 10 greatest monthly dividend stocks with high yields without further ado. All of these stocks give out dividends on a monthly basis. These stocks were chosen based on their dividend safety, favorable analyst ratings, and hedge fund sentiment. Number 6. SL Green. Another REIT is SL Green, which is the largest office landlord in New York City. While the city's office sector has been affected by the pandemic, SL Green has fared surprisingly well. The company's rental collection rate and leasing activities reflect this. In 2020, it collected 97.9% of the office rented billed and 94.8% of the total rent. Meanwhile, during the first 6 months of 2021, this REIT secured leases totaling more than 900,000 square feet at lease rates that were only 1.7% lower than expiring lease rates on the same space. This resulted in a 93.6% occupancy rate. This demand indicates that businesses plan to return to their New York operations in the future. Meanwhile, institutional investors continue to be attracted to office buildings because they provide dependable income. As a result, SL Green was able to sell a number of houses at acceptable prices. It utilized the money to pay down debt, repurchase stock, and invest in new projects. This REIT has also been able to maintain its dividend growth. It became a dividend achiever last year after achieving its 10th consecutive dividend rise. Number 5. Realty Income. Realty Income is the obvious leader when it comes to monthly dividend stocks. It bills itself as the monthly dividend company, and as of late 2021, it had paid 615 straight monthly dividends. Furthermore, since its initial public offering, IPO, in 1994, Realty Income has grown its dividend 112 times, including in each of the last 96 quarters. This REIT has increased its dividend for more than 25 years, making it a dividend aristocrat. Realty Income should be able to provide investors with a monthly income stream that grows consistently in the future. It has agreed to buy rival REIT Verite, NYSE, VER, in 2021, with the deal expected to finalize by the end of the year. The transaction will create a $50 billion REIT behemoth with a 10% increase in cash flow per share. It will also diversify its portfolio, while keeping financial flexibility to continue buying cash-flowing properties. Realty Income was on track to buy $4.5 billion in properties in 2021, excluding Verite. It has the financial capacity to expand because it has one of the greatest balance sheets in the industry. Number 4. Pembina Pipeline. Pembina Pipeline is a pipeline corporation based in Canada. Pipelines, processing units, storage terminals, and export facilities are all run by the company. Other energy firms are generally leased the capacity to use the company's assets under long-term, fixed-rate contracts. Pembina is able to provide consistent cash flow because to these partnerships. Pembina has a strong dividend history, with payouts consistently increasing over time. As it completes additional energy infrastructure expansion projects, it should be able to increase its dividend in the future. To drive future dividend growth, it has a large backlog of secured projects and several more in the development pipeline. Pembina is investing in lower carbon projects in addition to continuing to support the movement of fossil fuels. Along with its wind energy holdings, it's working on a carbon dioxide transportation and sequestration system with another Canadian energy infrastructure firm. It's also looking into hydrogen possibilities. Number 3. EPR Properties. Another REIT is EPR Properties. It focuses on owning experiential real estate like movie theaters, eat-and-play venues, ski resorts, and gaming facilities. The venue operators sign triple-net leases with it to secure these sites. The pandemic of COVID-19 had a major impact on experiential real estate. Many of these facilities were forced to close their doors or operate at a reduced capacity for a period of time. As a result, they were unable to pay their rent, forcing EPR Properties to stop its monthly payout last year. However, with vaccines becoming more readily available, many people are regaining confidence in their ability to enjoy adventures outside the house. As a result, EPR's tenants are catching up on their rent payments. The REIT was able to resume paying a monthly dividend in July 2021 as a result of this. EPR Properties' current yield is attractive, but as the REIT's portfolio grows, it may be able to raise it in the future. In the middle of 2021, it had more than $500 million in cash and an undrawn $1 billion credit facility, allowing it to go shopping for additional experiential real estate. Number 2. Gladstone Land. Gladstone Land is a real estate investment trust, REIT. It specializes in owning and leasing property and farm-related facilities to farmers on a triple-net basis. Because nutritious goods like fruits, vegetables, and nuts are less sensitive to price volatility than commodity crops like corn, wheat, and soy, it focuses on farms that grow them. Gladstone Land has a long history of paying out dividends. In the last 26 quarters, the REIT has boosted its dividend 23 times, increasing it by more than 50%. It intends to keep increasing its monthly payout at a faster rate than inflation. The company's expansion is fueled by constantly rising rental income from current farms, as well as a steady stream of new farm acquisitions. In the second quarter of 2021, Gladstone paid about $80 million for 13 farms and over 20,000 acre-feet of banked water. These investments expanded its farm portfolio, while lowering the danger of drought on some of its fields. Number 1. Agree Realty. Agree Realty is a real estate investment trust, REIT, which generates recurring rental revenue and hence makes for excellent monthly income stocks. The company holds freestanding retail properties with triple net leases, which means tenants pay for building insurance, upkeep, and real estate taxes. It focuses on holding properties that are leased to critical shops including groceries, home improvement, dollar stores, and drug stores, which are less susceptible to e-commerce or recession disruption. While Agree Realty is new to paying monthly dividends, it moved from quarterly to monthly in January 2021. It has a strong dividend track record overall. Over the last decade, this REIT's dividend has climbed at a compound annual rate of 5%. As Agree Realty expands its portfolio, the upward trend should continue. In 2021, it plans to buy up to $1.4 billion worth of buildings, boosting its rental income and dividend-paying potential. Agree Realty has a healthy financial sheet, which will help it continue to expand. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates. Thank you.